Time to see what's on the radar for Nate Thooft, CIO and Senior Portfolio Manager at Manulife Investment Management. And Nate, you've been watching the metals. Bullion climbed as much as 2%. It's dropped back. It was up. It was down today. I'm not even going to look at it right now and see where we're at after that winning streak that ended yesterday. What's your perspective on gold? And we're going to get into silver and some other options as well. But let's start with gold. What are you looking at with it right now?
I think this is a lot about time horizon. And what I mean by that is we obviously saw gold perform very well over the last couple of years, but then all of a sudden we had this geopolitical event that's happening and gold didn't act as well as you might expect in a risk-off event. And I think there's a number of reasons for that. One, gold doesn't have a yield. Two, it's not just driven by geopolitical risk. And so we had some people that were in gold that made a lot of money that had to delever or sell their positions in gold to offset some of the downfall we saw in other asset classes. So we saw an interesting dynamic with gold acting not as well as you might expect when we have this geopolitical dynamic going on. But when you stretch it out and look at longer term perspectives, we still very much like gold. The themes that are driving gold over the last 2 years haven't changed with this geopolitical event in Iran. In fact, they're still very prominent. Things like fiat currency concerns, debt concerns globally, inflation risk, geopolitical and supply dynamics. So all of those things are still in place as a broader theme underpinning the potential for gold to still hold up or even continue to go higher in our view when it comes to pricing over the next 12 months.
Any concern with gold? We've seen the U.S. dollar strengthen over the last couple of days. I think it's still a little bit today. Where does that fit in with gold?
There's two reasons why we've seen gold act up over the last couple of days. One is the fact that it doesn't have a yield. And so when interest rates went up, which also was a bit of a weird dynamic with a risk-off event, but as treasuries and global bond rates went up, gold underperformed because rates going up doesn't typically help gold prices. But the second theme is the dollar. And so the dollar appreciating is also a negative for gold. Our general view is that longer term, the dollar is probably still in the early innings of a secular decline. That doesn't mean the dollar is going straight down, but we think it's one of the underpinnings of gold continuing doing well over the next, let's say, 5+ years, because we think the dollar will not be as dominant as it has been over the last, let's say, 10 or 15 years. And so the backdrop in our view for gold when it comes to the dollar dynamics is fairly favorable because we think a depreciating dollar is positive for gold prices.
And now the Canadian dollar stayed strong, relatively strong to the U.S. over the last few days with what's unfolded. Gold companies here have benefited. Where do they fit in?
I think when you look at gold companies and miners, clearly if we believe that gold price is going to go up, there are going to be a lot of mining companies, particularly the well-run, high-quality companies that will benefit. And we probably will continue to see some consolidation when it comes to smaller miners being gobbled up by larger ones. And so I think the backdrop from a merger activity perspective, from a price of gold perspective, is still quite favorable for a lot of the mining companies, despite how well they've done over the last 2 years, with this broad underpinning that gold is still very well supported from a price perspective.
All right, and then let's talk silver. Different beast, sort of, not sort of. You got to have a strong stomach for silver, don't you?
You definitely have to have a strong stomach. There are certainly going to be more volatility there and more bigger price swings. But the underlying themes are in many cases the same. I would actually argue that there might be even a bit better because there's also some practical uses for silver that doesn't quite as benefit as gold as much. And so our view is that the general direction of silver will rhyme a lot with gold, which is just a lot more variability in the price and a lot more volatility in the price. And so the underpinnings are there for both gold and silver to continue to track well together as a trade. But if you're looking for the safer, more consistent performer, gold is the winner. When you're looking for something that has more volatility or potential upside, silver probably is a game that you might be willing to play from more of a speculative perspective. But they both have the same underlying pennies as it pertains to the drivers of their prices.
And just quickly before we take a break, any other metals worth looking at for you?
We like copper. I think copper is an aspect that there's a lack of supply or a limited supply. It's hard to bring on more supply. Demand is high. We think global growth rates, particularly outside the United States, will continue to pick up. So emerging market countries wanting and needing more access to copper. So generally speaking, we do like copper and continue to believe that it could track higher in the coming years.